Welcome, everyone, to this Legal Office Hours webinar. Today's topic, negotiating working capital in SMB acquisitions. My name is Will Smith. I'm the host of the podcast Acquiring Minds and a partner in Minds Capital, a fund that invests in independent sponsors. Attorneys James David Williams and Bill Barlow are back to host this session. You've seen them here many times. James David and Bill are partners in Barlow and Williams, a practice that specializes in small business M&A. So they're at the front lines of our market. Their focus is helping searchers, independent sponsors like you all do your deals. They also represent sellers, so they know both sides of the transactions in this market. We run this, the way we run these webinars is, as always, that Bill and James David have a presentation they brought. They will give that, and then we'll turn to Q&A for the back half. To ask a question, use the Q&A button in your Zoom. We have chat turned off. If you have a very involved, very detailed question, perhaps on a deal you're actually working on, sometimes those can be overly complicated to ask live here, but feel free to put that question there anyway, and James David will get back to you with an answer if it can't be answered live because it's too complicated. Now, if you do that, just make sure that you're not logged in anonymously. You can log into these webinars anonymously or with your name. If you're anonymous and no email address, James David cannot get back to you. We're recording the session, as always, so you'll receive a link to this recording in your inbox later today or tomorrow, as well as a link to the slides you're about to see. And finally, in the chat here are links to James David and Bill's LinkedIns. Connect with them on LinkedIn, to the Barlow and Williams website, and the email address for each of them. Okay, guys, over to you.
All right. Well, thank you everyone for joining us for this webinar. I just want to lay a few rules in terms of expectations. So a lot of discussions have been had on net working capital and a lot of great presentations. Most of them are done by accountants. We are not accountants. We cannot get into any of the technical items that accountants can, and we don't pretend to. What this webinar is about is more about the negotiation side. How do you take the frameworks that you might have negotiated with, or discussed, I should say, with the accountants and get them into the agreement? And importantly, how do you do that in a way that doesn't create as much friction with the seller? Because I'll have to say, this is probably one of the number one friction points with the seller. So a lot of this is going to be tricks, tactics, etc., helping you to help the seller see it through your perspective and making sure you preserve that relationship. And then, yeah, so just in terms of working capital fundamentals, a couple items to keep in mind here. So most businesses, it's current assets minus current liabilities. Most businesses, you're talking about accounts receivable, accounts payable, and inventory. Those are kind of the big three. There are other things, accrued paid time off, bonuses, we'll talk about those. But the idea is that when you go out and you make an offer on a business, you are making that offer assuming that it has a normal level of net working capital. Obviously, what you don't want to have happen, for instance, is for the seller to quickly rush a bunch of orders, get all that money in, and then leave you with a company that has sort of run out of gas. And so the idea is you want it to just be buying it so that the day you buy it, it's just a kind of normal, every day, the normal amount, the normal balance of all those things.
Yeah, and I'll say people take different approaches to working capital in the LOI. It's not uncommon for certain brokers to just say, "Oh, you can get the working capital from the bank. It's not a problem." Right? If you do that, just your purchase price is effectively increasing. So just be aware of that. At the time that you're submitting your offer, there is a major information asymmetry between you and the seller as to what that normalized level of working capital is. The seller may not know. That's not uncommon, but you definitely don't know. And so it's not advisable as a buyer to peg yourself to a particular number at the time you're submitting your offer. That has a way of blowing deals up later. Um, so let's just talk about sort of a little bit of the risks of not having working capital or not having sufficient working capital. Um, so if you buy a business, it doesn't have enough cash on the balance sheet or AR coming in or sufficient inventory to sell through or whatever. You might have to draw on a line of credit immediately. And if you have to draw on a line of credit on day two to make payroll, that's a problem, right? That line of credit that you're going to hopefully negotiate with your lender if you're doing SBA and even if you're not. Right. Again, if you are in the SBA world, get as much uh, in that working capital line of credit as possible, right? Make it as big as you can, but don't count on drawing on it, right? That is I've got break glass in case of emergency fire extinguisher on the slide. Like that's what that's for. That's not for, day two. Or like you shouldn't need that to keep inventory in stock, right? In the first 3 months of ownership. Like if you have that situation, you're in trouble. Because it just creates fragility, right? So if you've got if somebody's late, right, with an account payable, right, you're late with a receivable, uh, right, you still have expenses, you still got to be making payroll, and if you don't have a little bit of a cushion, then you can get into a pretty vicious cycle pretty quickly. And the most dangerous time can be the first few months after the change of ownership because you've got so much other stuff going on too.
Now, in this next section, we want to talk about how do you explain this concept to sellers? And we've actually been often as attorneys brought into conversations where we represent the seller and we discuss the offer on the table with the seller, and the seller will be like, whoa, 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 wait. How is it that I am, not getting my accounts receivable here? And so, we sometimes have to have a discussion with sellers that we're representing to help them understand what's market and make sure that they also realize we can ask for certain things, but we what's kind of normal. And when we have these conversations with sellers, and when you have conversations with sellers, usually we find there are two different analogies that work pretty well in explaining to them why you're asking for the working capital. The first is the car analogy. You say something like, well, if I buy a car, I expect the gas in the tank to be full, otherwise I can't drive it, right? Um, and the gas in the tank, that's the working capital. If I don't have that much money, then I'm not going to be able to run the business for those first couple months. And that's a very good intuitive way of understanding it, and sometimes that's sufficient. Sometimes sellers will even push back against that though, because they'll be like, well, gas in the tank, that's, $50 is one thing, but this is like, hundreds of thousands of dollars. Like, they'll kind of go through it. And another approach that we typically will use is say, well, let's just do a thought experiment here. Let's say that you kept all the accounts receivable and the buyer started the business day one. What starts to happen? Well, all the accounts receivable come in and they go right out the door to you. And the buyer is making, selling new products, but that's AR that's going to come in 60, 90 days. And in the meantime, the buyer is having to make payroll. They're having to, pay all their other expenses. So what's going to happen? Like it's a huge cash crunch. And we find that sellers intuitively understand, oh yeah, like that would be a big problem if, there's a lot of money going out the door and there's not any money going in the door. And I don't usually want to create that situation. Most sellers are pretty empathetic towards you. And so as soon as you kind of describe it that way and they see that you would be put in that bad situation, they kind of understand that. The one caveat is sometimes you have brokers that have sort of promised them to keep all the accounts receivable, and then you kind of have to be the bad guy, and or they make you be the bad guy. Then you say, hey, look, I would rather, the offer I gave, it's assuming working capital. I would rather pay a little more for a business with the working capital included than a little less for a business without the working capital. So my offer to you was a little bit higher, but it was because I knew that I needed this net working capital.
And the discussion can vary based on the characteristics of the business, right? If something has a bunch of stock, right, a bunch of inventory, you may not have accounts receivable in the same way, right? If you're consumer facing. But right, if you sell, right, if you get the business and you don't have your best sellers in stock for the first 2 months, right, that's obviously a problem, right? So it's a different flavor of the same conversation. But the conversation is a little different based on the specifics of the business. Okay. Next is sort of a couple of frameworks for working capital. This is probably as close to the accounting line as you'll get, and I'll try to stay well clear of it. But this is as detailed, setting the framework is about as detailed as I like to see in an LOI. If you get more detailed than this in an LOI, you're setting yourself up for problems as buyer or seller, right? Frankly. But two common ways that a target gets set, and the target means, right? So net working capital, it's the positive assets minus the negative assets, and that's a number, and whatever that number is the target. So for most of these SMB acquisitions, right, it's going to be a positive target. There can be weird situations where it's even negative, actually. Sometimes it's zero, but it will almost always be a positive number. Probably the most common would just be a rolling average, trailing 12 months, right? Just looking at a snapshot each month. That, right, per the bottom bullet may not make sense in a particularly seasonal business, right? In a seasonal business, it may be that you need to do a snapshot, over 3 years and just take from the same month over the past 3 years or something. Right, so you do have to account for things. And then another way that we tend to see more in software businesses and SaaS deals, but sometimes it works for other services businesses too, where there's not a ton of right accounts payable, maybe not even a ton of accounts receivable in the business. And so you'll just kind of negotiate for a couple months of operating expenses and call that the working capital, which ends up being a lot simpler, but it doesn't work, right? Something like that does not work if you have a ton of inventory or long-term projects or what have you. So.
All right. And one other point actually on the previous slide, the other thing to keep in mind is seasonality. So, we negotiated a deal with a tax preparation business. They had all their money coming in like a 4-month, 5-month period. And so buying that business right before tax season and buying it right after tax season, you needed an incredibly different number of cash on hand because you still had to pay the employees when you were out, outside the off season. So just keep in mind that happens with all sorts of businesses. Some businesses do a lot more work in summer, and just you have to make sure it's appropriate for the time when you're buying the business. So now what we're going to do is we're going to shift focus to kind of what you might call special situations. These are things that are not going to be an issue in every deal, but in particular deals, it can be the most important issue. And so we want to kind of work through them. One of the most common things we see is what's called work in progress. This is something you'll see a lot in construction. So, you might, be building a pool and it takes 3 months. You can also see it in manufacturing. Often you're kind of gathering multiple pieces together and assembling it over a number of months. You can have extended service projects like you're, building out some, well, that's kind of a bad word. You could be like helping an integration with a software, and that takes, 3 months to do. So the issue is that there's often a mismatch between when payments are received and when the costs are incurred. So you could have a situation where on one extreme, the the company works for the entire 3 months and then only sends an invoice at the end, right? Doesn't get paid at all. On the other extreme, you could have a company that takes 50% up front and hasn't even started work yet, right? And has that 50% in cash. And so, in both those scenarios, you have different, situations. So scenario A, the payments received, but work has not yet started. So a bunch of cash comes in. Most deals are done on a cash-free, debt-free basis. So imagine that the seller or the company just took in, $100,000 for a project. They got 50% of their payment up front. And then day two, closing happens and the seller just takes all that money out. That's a problem because, you need to buy things for the project, pay your workers, all that other stuff. And so, and also it's a problem on the other end, the seller who's done all the work, paid all the expenses, and then you come in day two and you get like a huge payment. They're not going to feel very good about that. And I think this one we'll talk about in the next slide, that the most common way to bridge that gap is a percentage completion basis. So say something like, look, if I've got 50% of the money, but I've only done 20% of the work, then the seller needs to add in, that 30% worth of cash in order to cover the difference so that I have the money to be able to do the work that I've already promised to do. On the inverse, let's say, I've done 50% of the work, but only gotten 20% of the cash. You want to say something like, well, when the job is finished and I get that additional 30%, maybe that goes out to seller, right? And sometimes it's not all of it that goes out to seller. Sometimes you say, look, I'll pay you for the costs, so the cost of the goods that were purchased, sometimes the direct labor costs. So I'm still going to get a profit from it, because keep in mind, you do need some of the profits because you need the money to do other administrative things in your business, as well. So that's kind of the most common way to deal with this particular situation.
Yeah. And as you might imagine, it can get very detailed. The percentage completion, the actual percentages are almost always estimates. And I've seen people fight about, is it 70% or 75%? Sometimes people just get in a tizzy about that. But what often happens when the purchase agreement, when we do what we do, is there will be schedules that list all the projects and all of it's a big table with multiple columns of costs incurred, revenue to date, expected completion, whatever. But you want to hopefully reach a shared understanding or shared framework early, right? If you can agree on the framework, then filling in the table, right, it just sort of, right, the chips fall where they fall. But if you don't have agreement on the framework, you're going to have problems.
And the other thing I'll say is specificity is your friend. It's a headache, but it's your friend, because the more specific you get with all the things, the less likely you're going to have a dispute post-closing and sour the relationship.
Okay, so now we'll talk about say cousin of that, and that's deferred revenue. So this deferred revenue is more a construct when there's a subscription component of a business. Doesn't have to be, but that's the most common. All right, so you'll see plenty of businesses listed that have, they are very right? Very clear, right? Annual subscription, right? Anything that's got that ARR in the sim, right? That means that people are paying those 12-month commitments. Sometimes it's monthly, but it can be annual too. And either way, right, you have this problem of, we'll just use the numbers here, right? So example, $120 annual subscription, so it's $10 a month, right? But there's 3 months left to run on that subscription at the time of closing, right? So in accrual accounting, right, that's a liability on the balance sheet. And so it feeds in, that's how it feeds into the whole working capital thing. Cash basis accounting, it's not treated that way, and conversion from cash to accrual, this is where some of these issues arise. But regardless, that leaves an issue, right? Because you still have to service that client, whatever that means. If we're talking about $120, it's probably a software product, and right, what does that service mean? Well, you need to be able to, pay your customer support team in case they have support tickets. You're going to have hosting costs. You're going to have a couple of other things. This is not, right, the numbers can be much larger in larger service contracts, but that's the sort of thing you would have in a SaaS business. So there's sort of three possibilities, we'll say. It's a range or a spectrum. All right, one, if you're the most aggressive for the buyer, is that the seller will leave the full amount of that deferred revenue um, in cash or feeding into the working capital target. Intuitive to understand. I mean, we have a seller favorable version here. The most seller favorable is that the buyer just eats it and just, it's like, whatever. I'll just want the customers. I don't care. So this isn't the most favorable, but a more normal seller favorable would be the buyer gets the cost of service, right? The hard costs that the buyer is going to incur, but is not going to get any portion of the residual revenue. And as you might imagine, it's pretty common that there's some split where the kind of gross profit gets split between buyer and seller. Again, common in, it's a bigger issue with annual agreements. But even if there's sort of monthly contracts and cash is coming in every day, this can be an issue as like stub months can be a thing. This is one where not infrequently people fight a lot about it and then discover that it's actually not that much money and don't fight about it anymore. So if it is an issue, right, it can be significant. But if you are going to focus your kind of negotiation efforts on this, I do encourage you to try to get a sense to at least confirm that it's real money. Because if we're talking about a few $100 or a few $1,000, this is not where you want to spend your negotiation capital.
All right. So another thing that can be tricky is inventory. Now, net working capital is supposed to include inventory, but for a variety of reasons, sometimes it ends up not happening. So the standard approach in most businesses would be to say, okay, inventory is a part of the net working capital calculation, so it counts towards the target, but there's some guardrails in place. So first of all, like inventory for stuff that is old or hasn't moved in 6 months doesn't, or maybe a year, years depending on the product. Generally, you don't want those to count. You don't want to buy inventory that you are never going to use. There's also often maximum and minimums. So, one risk is if you include inventory in net working capital and you go to closing and the seller says, congratulations, like I hit the net working capital target. And you're like, okay, that's great. And then you walk in and then you realize that net working capital is all this, excess inventory and there's no actual accounts receivable coming in. And unfortunately, most employees do not want to get paid with inventory of the business. So you're left with a cash crunch situation. And so that's why it's often good to build some maximum guardrails to say, look, I'll give you credit for inventory, but only up to this amount. I still need a certain amount of accounts receivable because I'm trying to avoid the cash crunch issues. Another thing that ends up happening not infrequently is that you treat inventory as a completely separate item. And this can happen for a couple of reasons. One reason that's common, honestly, is that the seller has no idea like what inventory value they have. Like their books and records could be off. Maybe they have like a bunch of spare parts. Maybe they don't really have a good system. And they're like, look, I'm giving you what I have and it's basically good and it's the normal amount. You usually want some representations about that inventory that, it's a certain, minimum value. But sometimes, that you're just not going to be in a situation to be able to count it. Or other times, you want to treat it differently for the other reasons that we have. When that happens, you often say, okay, you're giving me net working capital. Here's the target X. This does not include working or inventory at all. We're just not going to take inventory into account when we're doing the net working calculation. Separately, you're agreeing to give me inventory with value of at least X. And this inventory has to be good, saleable inventory, etc. And, a lot of times that's the best way to get over a hurdle, especially when you have these tricky inventory situations. Another thing you can do is you can have consignment. So consignment is basically a situation where you agree to buy from the seller the inventory as you get orders coming in. So that way, in some sense, it de-risks it from you because, if the inventory doesn't sell, you just don't buy it in the first place. And so that can be an alternative approach to help you sort of manage that situation.
Yeah, and it's not uncommon, again, just that a business will be listed, right, for a price plus inventory. Right? I'm sure that people have seen that on listings. And if that's the case, then it's possible, even likely, that the seller is thinking about the two as different things. Right? There's the business and then there's the inventory separately. I don't really understand that attitude. To me, it's all one, but brokers do it this way too sometimes. But regardless, you have to address your seller where they are. And I have to do this when I represent sellers too, right? If the seller is thinking about it as two different things, then it's probably going to be two different things in the documents. Consignment can get a little bit weird in SBA transactions because there's kind of different flavors of consignment. It also can matter a lot where the inventory is being stored as to whether a consignment mechanism works well. Because if the inventory is being stored like in a 3PL, in a third-party logistics sort of warehouse, then the seller may not be as keen to take the ongoing storage costs on as part of a consignment mechanism. So there can be additional wrinkles when we're talking about consignment. It is often the best way to bridge things, but there are wrinkles with it. Small thing, or usually a small thing, but sometimes it's not. And this does depend on what state you're in, but in many states, accrued vacation or PTO, right, however construed, some places there is a difference between sick leave and vacation time on this. So again, you have to bear down into details based on what state you're in. But in many states, accrued vacation or other PTO is earned wages, meaning that the employees have earned that money and are entitled to it, and that makes it a liability, right? A current liability, which makes it feed into the working capital calculation, right? Current assets minus current liabilities. This can be a little bit tricky though, because there are two options from a mechanical perspective. I mean, sometimes people just forget about this and realize it at the end, and it's like, oh, well, that was $25,000 I lost. Uh, so, make sure that it does get into the calculation. Um, Two options, right? One is that the seller just pays everybody out with whatever they're owed and they, zero it out. The other option is that you as the buyer will assume that liability effectively by crediting the employees with the balance on day one, and then at the purchase price just drops per the working capital calculation. This works the same way with any accrued bonuses. Like if there's commission, right? Salespeople on commission that is paid quarterly or something, and right, they're a third of the way through the quarter. We've also seen this work with annual bonuses. Like everybody gets a Christmas bonus at the end of the year. We're closing in November, so the seller agrees to leave, right, to pay most of that year's bonus. So that can go into this too. But regardless, this is one of those things that sometimes people don't think about and can be, right, even in smaller kind of SMB deals, can still be well into five figures.
And I'll just say, I think especially the point if you're closing near the end of the year, it can be a very nasty surprise to suddenly be like, oh, I have to, these people usually get a really nice, healthy Christmas bonus, and I wasn't expecting to pay all that. So, especially when you're doing it around that time, just be very careful.
Yeah, and we're getting to summer now. Schools are getting out. All right, so if you were to close at the end of May, and you're taking over a business with employees that have kind of planned on taking accrued vacation over the next few months, option A can be a little bit, right? Option A of having the seller pay it all out and then they start at zero again, you could have some angry employees. Uh, so that's something can be a little bit delicate, even if it's pretty easy from a mechanical perspective.
And then just a note here is that the way you do this in SBA deals is actually quite a bit different than how you do it in what, I might call normal deals. And a lot of times, if you deal with sellers who, especially if they have counsel that are more used to the more typical transactions, oftentimes we have to walk the counsel through what is and is not allowed by the SBA. And so that's why it's a really good idea to work with attorneys that know that process, because otherwise, you could send this agreement to your lender. They're going to have a bunch of markups and comments because they can't do certain things, and it'll delay the process and probably frustrate the seller. And there are a lot of kind of very specific ways to navigate that we're not going to get into, but again, that's a good reason why you want to work with people who do this all the time.
Yeah. And it's something that brokers aren't always used to, seller counsel is not always used to. Uh, we go back and forth with lenders on this sometimes when we represent buyers as to what is okay, what isn't. Um, but what you don't want, because if you do this incorrectly in your agreements, and I'm not saying that you all would do it, but it's more to counsel. But if this is wrong, the lender will force it to be fixed right at the very end of the process, right before closing. And that can be a very tense time anyway, right? Everybody's going to be tense as you get closer to close. And since working capital is money, right? Working capital is always money, right? And the money things matter more in psychologically in negotiations. Right? You really don't want to be tweaking mechanics at the last second because that gets people just hair trigger emotional reactions, and I've seen things almost go sideways because of it. So again, a reason to work with people who do this because it's just a preventable blow up. And all right, that's the end of the main presentation. So we are Barlow and Williams. All we do is M&A. We use flat fees for all of our projects, and we use milestone-based payments that are meant to align with, we talked about work in progress, right, in this presentation, right? Our own pricing model kind of follows that. And we think of it in project sense too, right? So we're not a traditional law firm, right? We don't count hours, we count deals completed. And we'll turn it back over to Will and answer some questions.
Guys, I want to compliment you on a great topic. As you said at the top, there have been a lot of working capital, net working capital related topics, webinars, comes up constantly in the interviews. But the and that stuff, the mechanics of that, it can get accounting and messy and complex and abstract. But it really, but and because of all that, it really is. Um, I mean, if we as buyers who are, incentivized to really study this and understand it can struggle a little bit, imagine sellers. So it really, I do think this whole idea of negotiating around how to negotiate around this abstract topic is as important as the mechanics of the topic itself. So really clever idea to talk about how to talk about networking capital. Good stuff. Really good stuff. I think people will refer back to this one a lot.
I'm glad.
Okay, a bunch of questions here. Well, people are asking about you guys. So real quick, what's the best way to schedule time with you? Aria asks.
Yeah, you can use the email that's on the screen right now. I think we'll put our emails in the chat. You email us and we will, right, there's a workflow that you run through. You don't get to us immediately. There is a little bit of a process, as you might imagine. A lot of people reach out. So, but even if you are very early in your search, right, feel free to reach out. We may not necessarily speak with you immediately, but we'll still give you a bunch of resources. But regardless, email. There's also a contact form on our website if that's helpful.
And let me just say something too for James David and Bill here, but also for a lot of the other webinar sponsors and presenters. They do with the explosion of interest in search, there is a lot of interest in just talking to vendors and picking their brain. And so the vendors have to be really careful about the calls they take because these guys could spend all day on the phone answering questions with tire kickers. No offense if you're a tire kicker, but they do have to be protective of their calendar. So do keep that in mind with Bill and James David, as with all vendors in our space. Guys, do you do neutral counsel? Sorry, I don't understand what that means.
No, we don't. We represent buyers or we represent sellers.
What is neutral counsel for the
Neutral
uninitiated?
counsel, some states don't even allow it, but a neutral counsel would be a lawyer who represents the transaction, right? Is just there to facilitate. And I take the position that that's nonsense.
A lot of people want to do it as a way of sort of reducing costs, and it's very hard to be actually neutral. And so, we avoid those entanglements because, yeah, we don't want malpractice claims against us. So.
Great. Okay, to the questions of the audience around this topic and explaining it to sellers. So just on the point about inventory being separate from the transaction, I like this question. Quote, I really struggle with understanding why so many sellers consider inventory separate from the business. The business already purchased the inventory, therefore it's already part of the business. Why would a buyer pay separately, i.e. again, for something the business has already acquired? I'm not going to pay for the equipment again. The company already purchased the equipment. It's part of the business. What am I missing on this concept of paying for inventory, positioning it to the seller as, hey, I'd be paying for something separately and or again?
Yeah, it's psychology. I mean, I've seen deals where the equipment is valued separately too. So that's not universal. More unusual, but we have seen it. But with inventory, it's yeah, it is. It's the psychology of the seller. And there are it's a lot harder if the seller doesn't know how much inventory they have. Um, it just the conversations are always harder, and I'm not surprised anymore when that's the case, but it's not uncommon for sellers to just not know how much they have.
Yeah.
And that, right, okay, we can agree on a multiple based on the historical financials, and that's the business. But if I don't know what this inventory is, well, then I'm not lumping that in. Right? That's a separate thing. We got, right, it's a black box. Um, I don't really understand that psychology, but it happens.
Yeah.
And then, yeah, go ahead, Bill.
Occasionally, you will find situations where there is inventory that so I have a seller right now that is inventory that has some gold-plated inventory from products that they end up not selling, and they said, well, that's not included. And okay, fair enough. That's not really part of the operations of the business. And I think there is sensitivity about excess. I think one thing that you could do at the sort of LOI stage is, you can make it clear that, your offer includes a normalized level you know, of working capital, including inventory. You know, if there is, and if there's a large excess of inventory, then the parties can continue to discuss that. Because what you really want to do is you really want to get in front of the seller and say, hey, what's the concern here? Because if the concern is just, well, I just think of it as separate, then you're like, okay, well, I think of it as the same, but I'm willing to pay like $100 for this business with its inventory, or I'll pay $80 for the business and $20 for inventory. Like either way, it's $100. Like however you want to think of it, that's how I'm thinking of it. And if they do come back to you and they have an idiosyncratic concern, they say something like, "Oh my gosh, like I have like way more inventory, or I have this special inventory that's not used." Then you can start the discussion about that. So sometimes the tricky part is how do you phrase it in the LOI in such a way that you can kind of get through and actually have the conversation with the seller. Because once you have the conversation with the seller, it's easier to kind of see what their actual concern is. And by the way, validate the questioner's concern, because you're absolutely right. This inventory, a normal amount of inventory, should be included in the business. You're not crazy to think that. It is normal. But sometimes you kind of have to adjust yourself to the seller's mentality in order to, in order to get the deal done, without compromising on the principle that, you're not going to pay more for a business without, inventory.
Bill, your thing about, I'll give you $100 for the business plus inventory, or 80 for the business and 20 for the inventory. I'm reminded of an interview I did last week where the seller said no seller note. I will not do a seller note. And so the buyer was like, okay, well, how about we do a 3-year consulting agreement where I pay you X for 3 years? And they were like, fine. Effectively the same thing, just framed in a way that, for whatever reason, the seller psychology found it palatable, but it was essentially, from our buyer's perspective, the same.
And I've seen the same happen with different consignment mechanisms for inventory, where it's like, that's not okay, or that's perfect. But however you need to make it work, and it is purely psychology. So, right, get in front of the seller, and try to get it unfiltered, right? Try to have this principle to principle if you can, this conversation. But if it's, I forgot what I was going to say. All right, go on.
Yeah, but if it's the same economically and it's just a matter of optics, then be flexible with your optics.
Yeah.
That's what I would say.
It can even be better for you in some of the asset allocation, the tax allocation. But again, that's bordering on accounting, and we're not here to do that. So,
and don't presume logic in your seller. They may have some psychological, so don't say to yourself, yeah, but I'm not going to offer them 80 for the business, 20 for the inventory because I've already offered them 100 for the whole thing. That doesn't make sense. Don't stop yourself by saying, oh, that doesn't make sense, because we're dealing with human psychology here, and things that might not make sense might actually be the unlock. So yeah.
Yeah, don't you can rarely argue your way, logically.
Yeah. If the working capital and transition planning issues you're addressing could lead to a higher sales price, why do you guys believe that these issues aren't resolved before listing the business for sale?
Because the brokers often are inexperienced and don't have the hard conversation with the sellers about how this works. And unfortunately, oftentimes it's a great business, but the broker just is not experienced with these things. And so the broker will sometimes make a bunch of promises to the seller, and then you have make you into the bad guy. And so, it's not a great dynamic because you want to be the good guy. You have to be the good guy here. You know what I mean? So, but to answer your question, it's because usually and there are some really great brokers out there, by the way. I'm not disparaging the good brokers, but there are some brokers that don't really explain this. And then, and that's why you see it come to market with kind of off-market expectations.
Yeah. And if it is a good broker, right, it's not uncommon that they've done a sell side QOE and they've got their own working capital target numbers before it ever goes to market. Right. So just because your QOE guy says one thing does not mean that the seller is not going to hire somebody else to come up with a different number. And that turns into a conversation. All right. So again, right, there's levels to this.
And sometimes in fairness to some brokers, sometimes there are really, really small businesses that frankly we often don't, represent, but where like working capital, it almost really is an asset sale. You're kind of like handing over, if it's like a food truck, I'm handing over the food truck kind of deal, you know what I mean? And so sometimes they're used to that mentality, and as, the deals get larger and more sophisticated, sometimes, they haven't quite adjusted to the new reality.
How often do you guys see that the broker will have done their own sell side Q of E, or the seller will have done their own Q of E?
It's becoming more common.
Why is that?
There's just a little bit more increasing sophistication among brokers that if people get disparaged brokers all the time, well, that kind of creates a market opportunity for somebody to do it better, and there are people who are doing it better now.
And I've seen situations where sellers have gone to market without a QOE being done. Then when they go to market, a QOE happens and they get a much lower purchase price offer. And they said, well, I would have never gone to market. And they blame their broker, for not doing that. And so brokers, when they've gone through that process, they're like, oh, wow, like I'm never going to represent this person again because I didn't, go through the process right the first time. And so I think those are situations where, I think brokers are becoming savvy that actually it de-risks it if they actually, do the diligence up front.
Yeah.
So.
And the broker would eat that fee, or they would convince the seller to pay for that.
I mean, if they're smart, what they do is they have a retainer when they start the engagement, and they use that retainer, or at least part of it, to pay for a QOE firm to go in and make sure they get the right numbers, right? Many brokers don't. Many brokers just take whatever the seller gives them and then apply a multiple to it and put it on the market, right? But then you have the downside of exactly what we just talked about. So.
Okay. James David, please elaborate. This is going back toward the beginning. Please elaborate on the rationale for limiting the LOI section to the timeline method versus having a more expanded framework for the formula to be used.
So the biggest thing you can have, like we talked about work in progress and the work completion work percentage completion method. Like we can have that in the LOI. If you know the inventory and you know that it's going to be on consignment, right? Put consignment, right? Or inventory will be purchased on consignment. What I don't like, so frameworks are okay in the LOI and good in the LOI. What I don't want is a specific number for any part of this. Sometimes people will put a cash minimum, but that's unusual. But you as the buyer have not been able to do a ton of diligence pre-LOI, right? You'll be able to do something, but you're not going to have access to everything, right? This is the information asymmetry. And so you as the buyer don't want to commit to particular numbers without knowing what, right, without having anything to base that on. So frameworks are fine. And exactly what the line is, sure, ask me later and I'll be able to lay that out in the context of a particular deal, maybe. But frameworks, good. And even if it's not in the LOI, you can kind of get to it pretty quickly thereafter. Um, but you want the frameworks early, but don't commit to numbers until you know, right? Until you have something to base the numbers on.
You mentioned adjusting the net working capital peg for seasonality. What are the best ways to calculate or present this, if not a TTM average?
Yeah, so let's say we have the tax prep business that Bill talked about. Okay. So a TTM is, it's going to be one number, but there's big spikes. So what I would do instead, maybe for that, is let's look instead of 12-month rolling, let's do whatever month of, target month of close, and what was the working capital that month, right? This, 12 months ago, 24 months ago, 36 months ago. And maybe, the couple months around it too, right? If something's built around weather, right? Tax season's not, but if it's construction, then spring comes earlier or later. Um, and so we're taking the snapshot at a different point in time to better account for the seasonality as opposed to the 12 month where it's just bup, 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 bup.
Okay.
Yeah, and you can look at historicals. You can also kind of, what makes sense in the tax prep thing, like you're gonna have 6 months of expenses with absolutely no money coming in, right? So you can calculate, okay, for the last couple of years, and you could probably project for the upcoming year, like how many expenses are you gonna have over those 6 months? That needs to be the amount that you have in working capital,
Just a few more, everybody. Can we go back to the slide where the buyer friendly on deferred revenue, the various buyer friendly, seller friendly, favorable? Thank you. So let's do a quick example. Okay. Questioner says, if I'm looking to buy an accounting or bookkeeping firm that has a high amount of deferred revenue, because I assume they collect a retainer fee upfront from the clients for the year, I guess. Can you clarify again how I should structure the LOI and purchase agreement in a buyer favorable manner to capture that as a buyer?
I think one thing you could do is you can simply say that the business includes, a normalized level of net working capital, including cash reserves for prepaid revenue, right? And so what you're signaling there is that if they do have prepaid revenue, that you're expecting to have, the cash for that prepaid revenue included in the purchase price. Or you might even just saying like including prepaid. There's a variety of ways to do it. I think it's good to call it out and just state something. I don't know if you have other ideas, James David, but
No, that's the easiest. Expect seller pushback, but that's the simplest mechanism.
yeah.
Sorry, and so understanding that the whole point here is that sellers have a hard time wrapping their heads around this stuff. Although I would think that the owner of a like a SaaS business or somebody gets paid at the top of the year for 12 months of service to follow would get it. Would get it that, if they sell into month 2 of the 12, that those remaining 10 months, new buyers going to need to service. They just don't, is the short answer, necessarily.
Varying levels of awareness, acceptance. Yeah.
Yeah.
I mean, it's something particularly in software that makes it difficult is because in their minds, they often think that the cost of service is basically zero,
Mm-hmm.
and that's not technically true. And so that's why they're like, yeah, but you're going to get new annual subscriptions coming in, the first day. And it's like, yes, but I'll have to service those. So, um, um, and honestly, we've represented a seller and with a large strategic that was selling to a large strategic, and that large strategic, as just their default, offered the seller favorable terms, where they, only took the cost to service the remaining, and that was in the SaaS space. So, it's not crazy for, especially in those industries, for there to be credit of some kind.
I have seen some SBA banks say that the SBA does not like to see deal price numbers change close to closing prior to closing. But some of these working capital items, like the level of deferred revenue left in the business, might not be determined until close to closing. How is this managed? Have you guys seen similar distaste for that with the SBA or SBA banks?
Yes, it happens. And the way you handle it is you try to get out in front of it as early as possible with different components. And it may be that we're getting kind of interim reports along the way, right? This can happen with inventory. This can happen with WIP. This can happen with AR. It can happen with with deferred revenue. It can happen with any piece as needed. Um, but yes, if things are going to change, then the lender needs to know early. An upward adjustment, and they'll kick it back to underwriting, which adds several weeks. If it's going to come in a little bit light, then usually that's okay. There's sort of mechanisms to handle that. If it's going to come in a lot lower, or if they're going to be way under the target, then that can be an issue too that you want to get out in front of. But if they're going to come a little bit under, there's sort of pretty easy mechanisms. Um, but if there's going to be any sort of real variance, get out in front of it early, because otherwise you can lose 2 or 3 weeks.
And this is where working with advisors, kind of what we said earlier, this is where working with advisors really does pay pretty handily, because one, they'll be able to identify this issue. Two, they'll be able to identify how to resolve this within the SBA framework. And three, they can explain it to the seller and frankly, sometimes even the bank itself, to say, hey, this is how we're doing this and this is why this is allowed, and get the bank comfortable with it. So, the alternative is sometimes, as James David said before, you have a blow up close to closing, it endangers the deal. So there's a lot of technical stuff, but again, that's why you just deal with somebody that's done it a lot, and you should be in pretty good hands.
Great. Guys, a couple quick questions on you. John says, I missed much of the presentation. Did you mention at what stage of the process you prefer that buyers engage with you?
Yeah, our favorite time is when you've sent an LOI and you've gotten red lines on that LOI. And if you need an LOI template, we give one away. So that helps. Reach out and we'll get that sent to you. Will we talk to you earlier? Sure. Will we talk to you later? Sure. Right. People come with signed LOIs all the time. I think we've got 3 calls with people lined up tomorrow, who are in that situation, right? So that happens. When that does happen, it's not uncommon that we need to clean a few things up to make it right, especially in an SBA deal, to make sure it's compliant. But don't hesitate to reach out. If it is too early, we'll tell you, and we'll tell you when to come back.
And even if we can't meet, if it's a little early, as we said before, we send resources, we send stuff. We love you guys. We wish we can meet with all of you, but in lieu of meeting with all of you, we do what we can to help answer. And sometimes there'll be a specific question you might have, and we might be able to answer that even earlier. So.
Can you share your fee-based pricing structure, or do we need to contact you that directly for those details? I guess that's asking about the specific costs.
I mean, we'll give you high level. I mean, high level, what we do is we will take a number of tranches along the way that roughly match our work. I mean, generally we take a small amount up front to do, initial legal due diligence, finalize the LOI. Then we take larger chunks, like when you tell us, hey, after the QOE is done, all that other stuff, say, hey, it's time to draft the purchase agreement. We take another chunk then, and then we take another chunk at closing, and you kind of pay as you go. Every deal is different. We give you a custom quote when we meet with you for that specific deal. And that pricing is sort of always changing as well. But generally speaking, that can be, and there can be more things. If you're an independent sponsor, there's different milestones and different things that you hit along the way, and there has to be some flexibility with certain things as well because those deals are more complex. So, in general, reach out to us and we'll help understand, help you understand and guide you through how we do it.
Great. Okay, audience members, if you want to connect with Bill or James David on LinkedIn, you should do that. Get their content. Another way of just keeping them on your radar and getting in touch. So their LinkedIn links are right there in the chat, as are their email addresses if you want to reach out, start a conversation, get a question answered. And then, of course, their website there at the top. They will be back next month. At least James David will be. Bill, we're all rooting for you. And we don't know what the topic is yet, but we should know that soon. So keep your eyes peeled. And audience, thank you for coming. Thank you for your attention, as always. And James David, Bill, great content as always, and a great topic choice on this one. So really appreciate it. Thank you for doing it.
Thank you, Will.
Thanks, everybody. This ends the webinar.